Okay. So the next item that we will be discussing about is the concept of tax as an item in your income statement, and also corresponding items relating to tax in your balance sheet. Okay. First things first, there are a few things that we have to understand as far as tax is concerned. Okay. So you pay tax on what? Income. So for the company, when profit income for the company, when will you know how much is the income? After 31st March or after 31st December, right? So that means this you will get to know only when you have calculated all the income, expenses, everything. Okay. And then say sometime in June or May, you will get to know how much tax exactly to pay. Right? On 31st March, you will not know. Okay. That means there will be an estimated amount that is arrived at, and then you charge your PNL, you debit your PNL by that estimated amount when on 31st March. Because you will know approximately how much net profit you will make or how much tax you will have to pay. One rough item, rough number, rough estimate you will know. But the actual estimate or actual number will come sometime in May, June, or we have this concept of assessment in income tax. That means only after the assessment is completed, you can say that, okay, my tax for the previous year is so much, right? You may calculate tax in the month of May, June, and you pay tax and you file your income tax returns. But then the income tax department may come back with some queries or with demand of tax, or may say that you paid more tax and all those things. That means only when the assessment is over, you will know what is the exact amount of tax that you had a liability as of 31st March. So when we are closing the books, right, we always close the books by creating a provision in the books, right? You create a provision, you debit your P&L and you credit your balance sheet, provision for income tax. Okay, then the actual number comes, right? You pay, you make the payment. Then that means there can be an under provision or over provision, right? Under or over provision, which can be rectified only in the subsequent year. Because why? Previous year I have already estimated one amount and I have closed the books. Now, let's say my previous year liability I had estimated at 1 million. And the assessment comes, it says only 800K. So that means you have over provided or under provided? Over provided. So that means this 200K has to be written back. This 200K will be credited in the current year, not in the previous year. Right? This 200 will be credited in the current year. Okay, it will be rectified in the current year. Clear? Okay, so this is one concept. Okay, provision for a tax, and the tax expense is the amount that you see in the PNL. It's a line item that you see in the PNL. Basically, current tax expense. Okay, and the tax paid amount, where will you see? In cash flow statement. In cash flow statement, you will see the tax paid. This number and this number will be different. What is the amount of actual tax paid in the year and what is the current tax expense will be different for this reason. Right? Are we getting it? Okay. So these are some of the basics and very simple. On income you pay tax. Okay. Understood? Over provision, under provision. Clear? Okay. Now, this was like basics about tax. Keep writing. Okay, this is very, very heavy topic. Lot of concepts will come within this. ஆமா இது வரைக்கும் நடத்துனதெல்லாம் ஈஸியா இது மட்டும் டிஃபிகல்ட்டா கேக்குறீங்களா ஆமா வாட் டு டு திஸ் இஸ் ஆக்சுவலி காம்ப்ளெக்ஸ் ஓகே so expense one some examples I'm giving before tax. Let's say tax at 20%. So okay, is this clear? Simple P&L statement. Right? Okay. Now, what happens is when tax is paid, tax is generally not paid on this. What is the process? The process is there is a tax calculation statement, tax calculation report. Okay, wherein what the income tax law will say is, he will do is, he will take your profit before tax, okay, and he will do adjustments as per the income tax law. Some adjustments will be done. What is the reason? What are those adjustments? Why those adjustments come? For example, let's say this expense, this particular expense is a penalty which you incurred, you paid for violating some law. Okay, so you paid penalty. Now that penalty which you paid is an expense for you. So you are putting in your P&L, okay, and showing it as an expense fair. But what the tax guy says is such penalties are not allowed as expenditure in the P&L. Right? So adjustment. Add back. Okay, certain. Add back disallowed expense. That means that expenditure is not allowed as an expenditure for income tax. So what you will do, what they will do, they will add back this. Okay, like this, thousands of items are there, thousands of rules are there. Okay, so what happens? Your taxable profit is this. Okay, your taxable profit is how much? 800. So what is the tax rate? Say 20%. You are paying tax at 160. So tax to be paid is 160. Okay. So this tax is what you will have to pay. Okay. So tax, you will not put say tax at 20%. We say tax as per tax statement. Okay, now in this, there are thousands of items that will come. I'm just giving one example. It can be adding also, it can be subtracting, reducing also. It can be either ways. Are we getting this? Okay. Now look at this. What is the rate at which I am paying tax? Huh? What is my profit before tax? How much tax I am paying? Then what percentage is that? Hmm? 32%. That is called as ETR. What is ETR? Tax divided by profit before tax. Effective tax rate. My effective tax rate is what? 32%. Even though the statutory rate is 20%, I am paying tax at 32%. Understand how you have arrived at how you have arrived ETR? ETR is tax divided by PBT. Okay, like this, there are a lot of items, not necessarily, as I said, not necessarily you will increase the profit before tax. It can be reducing also. So like this, there are a lot of items. For example, expense disallowed, expense allowed. Okay, or you can say deduction allowed, not expense allowed. Deduction allowed. Then income taxable, income not taxable. Okay, or instead of income, you can say receipt. Receipt taxable and income not taxable. For whatever is your income, that may not be taxable. Whatever you have not put in the P&L account could be taxable. Whatever you have put in P&L account as expense, that is disallowed. And some other deduction is allowed as an expenditure. 4 directions. Okay, I'll give some example. Expense disallowed is this penalty. This is an expense which has been disallowed, not allowed as an expenditure. Now, deduction allowed. What is this deduction allowed? Let's say I violated some law. Okay, previous year. At that time, it was disallowed. Okay, and I incurred a penalty. So, income tax department says you violated so and so law. You paid a penalty that will be allowed as an expenditure only when you take corrective measures. Okay, so this year I have taken corrective measures. It is not there in my current year P&L. Right? For example, let's say in another year I don't have this item at all, penalty. But in that year, that is allowed as a deduction. Right? Okay, so that is your deduction allowed, where it is not there in my P&L as an expense, but it is there in my tax calculation sheet. In which case your taxable income will come down. Okay. Then there are certain money which I have received, but I have not showed it as income according to accounting standards. According to revenue recognition, which we discussed, I have not showed it as income or revenue in my books. But the tax fellow says, this is a money that you have received, you have to pay tax on it. You have showed in income statement, your accounting standard is telling to show, not to show, we are not concerned. You have received this money, pay tax on it. So even though that money is not here, I'm not shown in my P&L as an income. It is there in my balance sheet liability, income received in advance. Right? In which case, the tax fellow may still say you have to pay tax. Now you have received money, pay tax. Right? Same money, when I show it as income in the subsequent year, right, that will not be taxable in the future. That is income not taxable. Or I am operating in certain area where government gives incentives, tax incentives. Right? I am operating in special economic zone. I am operating in SIPCOT, industrial estate. Government is setting industrial estate in some remote place. It is setting those who come and set up their factories or their industries here will get tax holiday For 10 years, no tax. For 10 years, your income is not going to be taxed. You set up your factory here. Any revenue that you get from your factory, from this factory, you don't have to pay tax. For any revenue you make in this particular, from this particular premises, no tax on that. Right? So incentives like this are given. So in which case that income is not taxable, even though that is included in your P&L, it will be reduced from here. Are we getting it? This is how the tax law works. Okay. If I have to give specific example, one specific example is PF. What is PF? Provident fund. Now, what is provident fund? Employer contributes some money and employee is contributing some money, and that money is being deducted by the employer and he has to remit it to the government or the concerned authorities. Right? So the employer's contribution will come as an expenditure here. Right? PF contribution towards employees will come as an expenditure here. And there is a rule that you cannot use those funds for any other purpose. You have to directly remit it to the government. That is prescribed in the PF Act. And that has to be followed strictly. If it is not followed strictly, and in audit, if you are caught, very severe punishments are given. Okay, prescribed. Now, to bring this into mechanism, to make sure that people are depositing this money, the employers are depositing this money on time, right? Government has taken a lot of measures. One such measure is through Income Tax Act, wherein you are telling, this is my PF expenditure, okay, whatever I have contributed to employees contribution fund, okay, as employer's contribution, okay, fine. Have you remitted this? No, I have not remitted it. In that case, it will be disallowed. It will be disallowed because you have not yet paid within certain time frame. Every month within 7th or 8th or some dates you have to remit. If you don't remit, PF authorities can come and take action. Income tax department or income tax law will not give you deduction unless payment has been made. Okay, and only when you make the payment, this deduction will happen. So what happens invariably every year? Okay, March. Okay, the due date is April 7th or something. Right, on March 31st, that 1 month salary, March contribution alone will not be paid on time. Why? Because it will be paid on April 7th. Before March 31st, they will not pay. They cannot pay. Why? Because salaries and all are paid. After that, calculation is done, and after that only it is remitted. So by March 31st, I have not paid that money. I paid it on April 7th or April 8th, 1 week's delay, which is okay. But what income tax rule says, by March 31st, have you paid? Right? Only if you have paid, you can get deduction on this. Otherwise, you will not get deduction. So what will happen invariably, because I have not paid, it will be added back in, let's say, financial year 2023 financial year, 2024 financial year. Now, in this year, because I have not paid, it will be disallowed. But PF expense relating to previous year, I have paid in which year? In this year, I have paid. So in this year, it will be allowed as an expenditure. Okay, now that is something that is a regular item which is seen across all the companies. Okay, because the deadlines are like that, you cannot comply. You are paying on April 4th, 5th, 6th, 7th only. So you cannot say I have paid by 31st March. So obviously that will be allowed as a deduction. So now these kind of things, this is one example. Another example is purchase an asset, 100,000, or I have set up a factory in SIPCOT or in an industrial estate. I'm setting up a factory. Okay, the cost of that factory is so much. Okay, it's a 5 years project. It's a 5 years project, and how the over 5 years I'm going to depreciate it. Okay, so let's say year 1, year 2. Every year I'm making this revenue. Okay, After allowing all expenses and all, okay, all other expenses except depreciation. Okay, let's say my expenses is expenses apart from depreciation, or I'll say, okay, profit before depreciation. Okay, what is that? Profit before depreciation is this. For the sake of analysis, I am doing this format. Okay, total. Profit before depreciation is how much? 70,000, 70,000. Okay. Now, tax at 20% is how much? Okay. PA, PR, net income is right here. Okay. However, what the government says is because you have set up this factory in SIPCOT, I will give you depreciation benefit over 2 years. Income tax depreciation benefit over 2 years instead of 5 years. You can claim depreciation over 2 years. Okay. So what will happen? Tax calculation will go for a change. So now you will bring in. This is what.
Sir, your voice is not audible.
Yes, am I audible now?
Now it's okay, sir.
Okay. Now let us do tax calculation. Assuming this is profit before depreciation and tax is this amount. Okay. So profit before. Where is depreciation? Where is depreciation in this? நல்லா சும்மா இருக்கீங்க. Depreciation over 5 years. Okay, this is what? PBT, profit before tax, tax at 20%. So this is my PBT. Okay. Now, because the tax cannot be calculated like this, why I'm getting some benefit from government on depreciation, and although otherwise also tax has to be calculated, tax has to be taken from tax calculation statement, not a direct.
Sir, again your voice got discontinued.
Yes, am I audible now?
Yes, sir.
All right. So PBT, I'm taking from here. Okay. Now, what will come here? Adjustment. What is the adjustment? Depreciation as per books. This is how much? This number. Okay. Then depreciation as per IT. What are they telling? You can claim depreciation within 2 years. Okay. Now, when you're, as far as income tax is concerned, your book depreciation is generally not taken. For income tax purpose, they will have their own depreciation rates for everything. In your books, you can depreciate at the rate, whatever rate you want, you can depreciate. But for tax purpose, they will tell some rate. At that rate only, you can calculate depreciation and claim depreciation. That can be more or less also. You may claim less depreciation in your books. You may claim more depreciation in books. That doesn't matter. But whatever rate they are giving, at that rate only you can calculate depreciation. So invariably, I will add that depreciation and I will reduce the depreciation which the tax fellow is giving. So the tax fellow is telling you can claim depreciation over next 2 years. Overall, how much? 100,000 only. 2 years, 50,000 each, 50,000 each. Okay. Now, taxable profit is what? 50,000 plus 20 minus 50. Right? Taxable profit is how much? How much? Okay. Tax at 20%. This is what we wanted. Right? Now what we will do is I will put this tax item here. Okay. Now before I proceed, update this at your end quickly. Note it down. Depreciation as per books, you are adding back. And whatever they are allowing, that you are deducting. Work out these two tables first. Or what you can do is instead of that table, you can take up this table first. This table first and then this table. Here you will take this number from this table. Give that reference. First do this table, then you can do this table. Simply don't copy the numbers, understand how they are getting calculated. You're adding back depreciation.
Sir, on clarification, adding back depreciation is they're giving the 50% for the total thing, or else 20% also. That's, I mean, 20,000 separate and 50,000 also additionally have to take.
This 50% is on this asset value.
That's okay. And 20,000 also taken into account, sir, on that same year normal depreciation.
Which
Straight
20,000?
line, straight line depreciation as per.
This is only a calculation. No, you are paying.
Your voice not audible, sir.
So selling, you are paying tax on
Okay.
the revised tax profit, revised PBT.
Okay.
Okay, so this is the taxable profit. This is the item which we are calculating now again.
Okay. Sir.
On this, you are paying this tax.
Okay.
Tax statement. Right? Is this
Okay,
clear?
sir. Okay, sir.
Okay. Now, I hope everyone has got this. Now, can you tell me what is the ETR for each of the year? ETR. What is ETR? Huh? Calculate the ETR for each of the years. So ETR is 8%. Right? Are we getting this? Now going back. So I said one item that we discussed was PF. Right? The other item is depreciation. Generally, these are commonly considered items. Depreciation is more common. You'll see in every company's tax calculation sheet. Okay, where it is allowed in 1 year, and or even without this special benefit. Here you're talking about a special benefit where they are telling you can claim entire depreciation in 2 years. Even without that also, there can be a difference in depreciation. Right, here they are telling 20% depreciation, but income tax may allow 25%, sorry, 40% depreciation. Income tax may allow 50% depreciation on written down value. Right, income tax depreciation rates are on WDV method. So if that be the case, depreciation as per IT, okay, I will only do, you don't have to do anything here. So into 25%, first year, second year will be Third year will be right. Fourth year will be so if income tax is generally on WDV method. So even if they do like this also there will be a difference. Right? That means depreciation is one such item which will always cause a difference. Okay. Right? So one is like basically deduction allowed, deduction not allowed. This will cause a difference. And what will happen is, now what is happening? Look at in this case, ETR is 8%. ETR is 8%. That means what? It shows as if you are paying very less tax. Correct? And actually you are paid less tax. Government rate is, statutory rate is 20%, but you are paying at the rate of 8%. It is as if you are paying very less tax, point one. Point two, and in the future, in the subsequent years, you are paying more tax. In year 3, year 4, year 5, what is the statutory rate? 20%. But what is your effective tax rate? 28%. It looks as if you have paid more tax. Okay, point one. Point two, in the first 2 years, it looks as if you have performed well compared to the next 3 years. But is this because of your business performance or is this because of the government regulation? It is because of the government regulation. But it shows as if my performance is better in the first 2 years and performance in the subsequent 3 years is not so good. Right? Even though my performance across the years is consistent. Every year I'm making certain amount of revenue, okay, and it is consistent year on year. There is no change in my performance. But this tax is making my net income reflecting as if I've done well in first 2 years and I've not done so well in the subsequent years. Right? This is one impact. The other impact, if you see, overall, how much depreciation I'm claiming as per Income Tax Act? How much depreciation I'm claiming? 1 lakh. How much depreciation I was wanting to claim overall? 1 lakh. So that means overall, is there any change? Overall, how much tax you were expecting to pay? 50,000. Every year I was assuming that I will be paying 10,000. Overall, 50,000. Now, how much tax you have calculated overall as per tax calculation sheet? 50,000. Right? Here also you are paying 50,000. That means overall, is there any impact? Overall, there is no impact. But because of this rule, it shows you have made more profits and then you are making less profits. Finally, it is coming to the point where we had to reach. Right? I had to travel. From point A, I wanted to come to point B. Right? I have come to point B. But instead of coming like this, I'm going like this, going down and then coming here. Right? Ultimately, I'm paying only so much of tax. Right? Ultimately, my profitability is this only. But there is a temporary difference.
But high depreciation
difference. Yes, come again.
Does this mean that high depreciation business can benefit out of it?
Come again.
Does this mean that high depreciation businesses can benefit out of such a situation?
High depreciation businesses can benefit out of such situation.
Yeah.
Is your point?
Yeah, I'm asking you whether this can be utilized in such a way that high depreciation businesses can utilize the situation and probably sell the existing machine and then get a new machine again in the next year or the third year and then work on this.
We will come to that point. We'll come to that point.
Okay.
We'll come to that point. That is something towards the end of deferred tax that we are talking about.
Okay, sir.
Okay, yes, ultimately that will happen. I'll tell you how it works. Okay, so the point that I was trying to tell here is overall there is no change. Overall the impact is same, but there is a timing difference, there is a temporary difference. Okay, why? Because otherwise also you had to claim 1 lakh depreciation, and government here also claiming 1 lakh depreciation. Instead of 5 years, you are claiming it over 2 years, right? So that means this is a temporary difference. Okay, now this penalty I told, penalty they are not at all allowing. They are not going to allow in the future. Let's say penalty you have incurred, that is added back as an expenditure, added back as an income, like this. Okay, and it is not going to come back in the future. So in that case, that is not a temporary difference, that is a permanent difference. This difference is temporary difference, but this difference is what? Permanent difference. Why? It is not going to be allowed. Whatever I am paying more tax today, I am not going to pay less tax in the future. Why? Because it is disallowed. Government is telling this cannot be treated as an expenditure. Are we getting it? Here, I am paying less tax today. In future, I am going to pay more tax. Overall, I am paying same 50,000, which we were supposed to pay. That means that is coming back. That means this is only a timing difference, temporary difference. This difference is called as a permanent difference. Now here the depreciation impact I showed, it could be like this also. What will happen in that case? Government is telling these industries we will not allow depreciation now, will allow only in the future. So that means what? You are paying more tax now, you will pay less tax in the future. Still overall, so this is still a temporary difference only. Are we getting it? Now what is happening? Tax is getting deferred. Either you are paying more today, in which case you will pay less in the future, or you are paying less today, you will pay more in the future. Okay, so to address this anomaly, because of the taxation system, right? Your ETR is going for a toss, your performance is appearing as if you are not performing consistently. So in that case, it is not showing a reflecting, or it is not resulting in reflection of a true and fair view. So we have accounting standard, okay, basically IAS 12 explicitly for tax, okay, which gives a solution for temporary difference or timing difference. Okay, it gives a solution. The difference is generally classified between classified as two items. Okay, temporary difference. Okay, that means this will reverse in future, whether high or low, whether a benefit or a disadvantage, it will reverse in future. Okay, permanent difference will not reverse in future. Okay, so for this, what you have? You have deferred tax adjustments. Okay, here no adjustments. That means we will not do any adjustment in case of permanent differences. In case of temporary difference, we will do adjustments. How these adjustments are done? Are we clear? First, have we understood what is the impact and what is the issue. Okay. Now let us understand how this is going to be addressed. So what accounting standard 12, okay, or what this accounting standard says, IFRS says is, right, if there is a temporary difference, then reverse that temporary difference by an adjustment. How will you do that? That means you will put book entries in form of deferred tax. There's no cash flow impact. Last week also we discussed a lot of items. Whatever accounting standards are talking about to do adjustments like this or to account like this, there is no cash flow impact. These are only notional entries. Okay, no cash flow impact. You will still pay. Income tax authorities are not concerned about whether you are following deferred tax, not following deferred tax. For income tax authorities, what is important is this. You have to pay this tax. However, whether you account in books or you don't account in books, that doesn't matter. Right? For them, you are following deferred tax, you're adjusting your books, not adjusting your books. No. This is your PBT. This is the calculation, pay tax on this. Okay. But because this is creating an anomaly, right? This is creating a not so relevant picture, right? How do we add this as how do we adjust this? So what they're telling, wherever this timing difference or temporary difference is there, reverse it by a book entry. How will you do that? Very simple. You will see what is the difference. Okay. The difference is what? This minus this, correct? Where is the difference coming from? Right? The difference is coming from these items. Ultimately, the difference is 0 because it is reversing. Right? What is the tax impact on this? On this 30,000, what is the tax impact? 6,000, 20%. Right? So, today, you are paying more tax or less tax? Huh? Today, you are paying more tax or less tax because of this. You are paying less. Right? You are paying less tax. Right? In future, what will happen? You'll pay more tax. Right? This is a timing difference. So today you are paying less, but in future you will pay more. So in future, if you have to pay more means what? You are creating a liability for yourself. Right? So because you are paying less tax today, your P&L is having a lesser impact today. Correct? So you will debit P&L, okay, and credit what? Deferred tax liability. Correct? So what will happen is in P&L, you will debit P&L by 6,000. DTL will become deferred tax liability will become. In your balance sheet, you will show deferred tax liability as 6,000. Correct? So what will happen? This, you are debiting the P&L, right? So 6,000. Now what amount will come here in my P&L? 10,000, right? 6,000 plus 4,000. Okay. Now revised books. One second. Revised books, that means after accounting for deferred tax. Let me do it, then you can make a note. So everything is same. Current tax is how much? As per tax calculation sheet. Okay. Deferred tax. What did you say? Debit your P&L. So this will increase. Okay. Total tax is how much? Right? Okay, what is your PAT? Okay, now likewise, what will happen next year? What I'm going to do? Next year, you're paying less tax or more tax? Less tax. Will you pay more tax or less tax in future? More. So what will you do? Same debit P&L, credit, DTL. How much will be the amount? Here, 12,000. Your DTL will become 12,000. Already you had 6,000, right? Now your DTL will become okay. Now, so my deferred tax item number will come from here. See now what is happening. Okay. Now, third year. You're paying less or more? Huh? You're paying less tax or more tax? You're paying more. That means in future you'll pay less. But we know for a fact that this is belonging to an item in the past. Right? So, paid less already. Right? And you're paying more today. Okay? So what will happen? If you're paying more, what will happen? You will credit the P&L and debit DTL. Right? How much credit P&L? 4,000. DTL will be 8,000. So what will happen? You will take this number from here, 10,000. Similarly, let's see now what is happening. This is only a notional item. This is notional entry. Okay, this is not your actual cash is not this. Your current tax is your what you are going to pay, or that is a provision for tax. What we calculated. This is adjustment entry. Net, because of this adjustment, what we have done is we have nullified the impact of deferred tax. What you are paying is what the tax fellow has told. There is no change in that. But you are having a deferred tax item here in your balance sheet. Okay, DTL is how much? 6,000, right? The next year it will be this plus this. Ultimately, it is becoming 0. Okay, this is the concept of deferred tax. Now, this can be DTL or this can be DTA. Let me come here. Go down and come back. This is DTL. It can be DTA also. Are you getting it? Right. So if it is DTA, what will happen? You will credit the P&L. You will debit balance sheet DTA, and the same will be the effect. Okay. Now you can update these numbers. Understand and update. Make a note of these numbers. Ultimately, here also the total will be same only. You're paying less today, so you'll pay more in the future. Any doubts? Please let me know. It can be because of any item. Depreciation is one example. It can be because of any item. Like say I put one expenditure here, that expenditure is so much. You are claiming that in 1 year, but income tax fellow says you will claim it in 4 years. It can be because of that, or vice versa. Depreciation is one easier to understand. That is the reason I have taken depreciation. Work it out quickly. Revised books, revised P&L. This is the net income that is reflecting true and fair view. This is the revised. This is how I have to present my books. There's no changes. This was your P&L. Okay, I will show now. Your P&L was like this before. 46, 46, 36, 36, 36. Now it is. It is not that I want to show equal profits every year. It is not about that. It is about addressing this anomaly. Now your ETR is what? Are we getting this? Without this adjustment, my P&L would have looked like this. But with this adjustment, my P&L is like this. This is a notional entry. Currently, what you will pay is this only. Any doubts? This in case of temporary difference only we do this. In case of permanent difference, we will not do anything. You leave it like this. It can be both also. I can have multiple items. No, this is a difference because of one item. I can have other item also. Right? So in that case, I will have, so a company can have both DTL, DTA. Deferred tax asset also, deferred tax liability also. In one asset, the benefit is like this. The treatment, the numbers are like this. In another asset, the number could be different, or there could be any other item also, which can cause these kind of differences. Okay. For example, what is that item which can cause a difference? Let's say I am having sundry debtors. Okay, of 100,000. Okay, in my P&L, I am creating a provision at say 5%. Okay, provision for bad and doubtful debts. Okay, income tax fellow says we cannot allow this. Right? Income tax fellow says, has this number become bad? No, we are only creating a provision. Okay, so we will allow only actual bad debts, not provisional bad debts. Right? Now let us say your profit before provision and tax is how much? Let's say it is around 45,000. Your profit before provision is 45,000. Okay. Provision for bad and doubtful debts is 5,000. PBT is 40,000. Tax at 20% should be 8,000. But I will go to tax calculation sheet. PBT is how much? 40,000. Adjustment. Huh? What? Profit before provision, 45,000. Provision for bad and doubtful debt is 5,000. So net profit before tax is 40,000. Okay. PBT I am taking 40,000 here. Add back this 5,000. Okay. So taxable profit is 45,000. Tax at 20% is 9,000. Okay. So tax per tax sheet is how much? 9,000. Okay. ETR is 9,000 divided by 22.5%. Okay. However, now this is a temporary difference. Right? This could be a temporary difference. If it is a temporary difference, we are not sure. Why? Because I do not know whether this will actually become loss. Right? However, in this case, I know, yes, this will become a loss because I know that this fellow will not pay. As a business, I know that this fellow will not pay. But income tax fellow says, let him first file a bankruptcy. You get it confirmed that let it actually become bad debt. Right? You, based on your experience, you are creating a provision, which is okay, but let it become a bad debt, then I will allow. So that I know in future it is going to be a bad debt. So in that case, I am creating a adjustment as per IAS 12. Now in this case, tell me what should be the adjustment for deferred tax.
1,000 rupees, 1,000 asset debit. Deferred taxes. Deferred tax asset debit, then credit.
Why credit P&L? You're paying more now. Okay. You're paying more now so that you'll pay less in the future. So it is a deferred tax asset. right? So what will happen? You are paying more today, will pay less in future. Okay, so because entry is P&L credit, PTA debit. So what will happen? Tax as per tax sheet, deferred tax. Deferred taxes, how much will be the amount? 1,000.
First case,
8,000 now.
we provided the provision, the net profit. would be-
The difference item, the difference is how much? 5,000. You have to see which item is causing the difference. This item is causing the difference. What is the amount? 5,000. That into tax rate is how much? 1,000, right? So, and because you are crediting the P&L, 1,000. Okay, so net your tax is 8,000, right? So okay, net tax is 8,000. ETR will be 20%. Getting this? So this can be because of any item. Wherever very simple treatment as per income tax law and your books of account. If it is different, means it will create a difference. So you have to see whether it is a temporary difference or a permanent difference. If it is a permanent difference, then you will not do any of these adjustments. You will leave it as it is. Company. You analyst will not do any adjustment in the books of accounts. You can do analyst adjustment is there, that you can do changes. Analyst adjustment is LIFO reserve. LIFO reserve will be given. From that you can convert to FIFO inventory and FIFO COGS. That is your analyst adjustment. This is the provision of accounting standard. Accounting standard says you should do like this if you have items like this. Clear? Are we getting this? Any doubts? Arun sir, clear? Ranju, clear? Any doubts so far?
Yes, sir.
Okay, so we'll pause here today.
Yes, sir. Yes, sir.
Yeah, this is not yet complete. We'll need maybe another half an hour or 1 hour more. That is little more complicated within this. Okay, basically a summary of what we have done. Okay, arriving at deferred tax and deferred tax asset and liability, your book tells a different way. Okay, not this way. Even though they have taken these kind of examples are there, how to arrive at this number, they are telling in a different way. So I have to discuss that way also. That will take probably another half an hour or maximum 1 hour. After doing that, we will continue with the further topics. Okay. So we will take it up this in the next session.